They said it was just another tariff threat, but what followed was a financial aftershock no one saw coming. Trump's bold ultimatum to China didn't trigger a traditional trade war. It detonated a global currency shift. Within weeks, over $500 billion, 0 cents, in trade activity started unraveling as China executed its boldest move yet, dumping U.S. dollar reserves and accelerating settlement in alternative currencies. The response wasn't loud, it was lethal. U.S. markets blinked. Global partners hesitated, and Wall Street watched in disbelief as the greenback's dominance began to shake. This isn't just retaliation, it's redirection. While Washington played old games with new threats, Beijing quietly rewired the rules. And now, the question isn't who wins the trade war, it's who rewrites the system beneath it. What began as a routine policy announcement in January 2025 quickly turned into a turning point for global trade. Former President Donald Trump, now a leading candidate in the 2024 race, unveiled a sweeping 60% tariff on all Chinese imports, double the rate from his first term. Markets expected retaliation. What they didn't expect was China's silence. No counter tariffs, no threats, just action. Behind closed doors, Beijing began liquidating dollar reserves, quietly settling trade in yuan, rubles, and dirhams. By the end of Q1 2025, over $500 billion, 0 cents, in trade flows had shifted away from U.S. currency dependence. This wasn't just economic defense, it was strategic offense. According to a report from the China Securities Journal, digital yuan usage in cross-border settlements surged nearly 20%, while Chinese state banks ramped up non-dollar credit facilities for exporters. Nations like Brazil, Russia, and the UAE followed suit, clearing transactions without a single U.S. intermediary. For decades, the dollar wasn't just a currency, it was the foundation of America's leverage. But Trump's aggressive return to protectionism may have accelerated its erosion. Because while the White House was focused on tariffs, Beijing was quietly executing the next phase of a global financial realignment. Trump's economic doctrine has always leaned on pressure, tariffs, sanctions, and bold rhetoric, but in January 2025, his proposed 60% blanket tariff on all Chinese imports wasn't just campaign theater. It was a seismic policy shift, designed to cut trade deficits and punish what he calls economic manipulation. The tariff was a full-scale return to confrontation. Yet, instead of weakening China's export machine, it triggered something far more disruptive: strategic decoupling. Découpe. DQP. In the weeks following the announcement, Chinese exporters began rerouting financial operations. Instead of relying on dollar-denominated invoices, they shifted to yuan-based contracts, supported by Beijing's vast network of bilateral currency swaps. Backed by state banks, exporters received incentives to adopt ECNY, China's digital yuan, for international settlements. The move wasn't publicized. It was deployed. Data from the China Export-Import Bank showed a spike in yuan-backed trade credits, offering interest rates nearly 1% lower than equivalent dollar loans. And with partners like Pakistan, Saudi Arabia, and Indonesia already integrated into China's digital settlement systems, the shift was almost seamless. Trump's $500 billion 0 cents tariff move was meant to assert dominance. Instead, it became the catalyst for a financial migration, away from the dollar and toward a system where U.S. leverage no longer defines the playing field. China didn't hold a press conference. It didn't release a fiery statement. Instead, it launched a silent counterstrike, one aimed not at tariffs, but at the very system behind them. In the weeks after Trump's announcement, China began offloading portions of its U.S. Treasury holdings, redirecting liquidity into alternative assets and foreign reserves held in currencies outside the dollar orbit. At the same time, the People's Bank of China accelerated digital yuan settlements across strategic trade corridors. Energy imports from Russia and Saudi Arabia, once priced in dollars, quietly transitioned to ECNY contracts. Reports from Bloomberg confirmed a sharp rise in non-dollar settlements across oil, agriculture, and electronics. The ripple effects were immediate. In March 2025, the IMF flagged a sudden spike in currency volatility in emerging markets heavily reliant on dollar liquidity. Several Asian economies, already connected to China's CIPS, cross-border interbank payment system, began pivoting to yuan-denominated trade to hedge against future instability. This wasn't retaliation, it was redirection on a systemic level. By turning away from the dollar, China didn't just respond to Trump's threat, it exploited it. And in doing so, it exposed a financial architecture built on the assumption that no one would ever dare to walk away. The $500 billion zero-cents collapse in trade wasn't a sudden crash, it was a quiet unraveling. U.S. tech firms, agricultural exporters, and industrial suppliers saw contracts stall, rerouted, or outright canceled. Chinese buyers, once major customers for American soybeans, semiconductors, and machinery, began sourcing alternatives from BRICS nations, often settling payments in local currencies or through China's digital rails. According to the U.S. Census Bureau, Q1 2025 showed a 17% decline in exports to China compared to the same period last year. But the damage ran deeper than numbers. Financial institutions began noticing unusual gaps in dollar-settled trade invoices. The Society for Worldwide Interbank Financial Telecommunication, SWIFT, reported a measurable drop in U.S. dollar usage across Asia-Pacific transactions, many replaced by yuan or UAE dirhams, approximately $0.50. Even legacy trade partners like Vietnam and Malaysia began shifting portions of their trade finance operations to Chinese-backed platforms, citing lower costs, faster clearance, and insulation from U.S. sanctions. This wasn't just lost revenue, it was lost influence. America's traditional export dominance was now being priced out, not just economically, but strategically. As the world adapted to China's alternative systems, the dollar's grip on global trade began to loosen. Not with a bang, but with a series of quiet exits. As the U.S. and China escalated their economic duel, the rest of the world was forced to choose or adapt. For many emerging economies, the shift wasn't ideological, it was practical. Countries burdened by dollar-denominated debt and exposure to U.S. interest rate swings saw an opportunity. Decouple from the dollar and plug into China's growing financial ecosystem. In Latin America, Brazil expanded its currency swap line with China, allowing direct yuan settlements in agricultural and mineral exports. In Africa, Kenya and Nigeria began experimenting with ECNY-based infrastructure payments, bypassing traditional dollar clearing banks. The IMF quietly acknowledged in an April 2025 report that over 30% of developing nations had initiated or tested non-dollar trade settlement systems, many connected to CIPS. The Gulf states, long pegged to the dollar through petrodollar agreements, began hedging. The UAE and Saudi Arabia executed test shipments of crude oil to Asia settled in yuan, a move unthinkable just 2 years prior. Meanwhile, Russia deepened integration into Chinese digital finance rails, using ECNY to sidestep sanctions. This isn't just a currency shift, it's a structural rebalancing of global financial gravity. As more nations diversify away from Washington's reach, the dollar's role isn't just being questioned, it's being replaced, trade by trade, transaction by transaction. Washington's traditional tools, sanctions, tariffs, and financial blacklists, once shaped global behavior, but in 2025, those levers are starting to lose their pull. As more nations pivot toward China's financial infrastructure, the U.S. finds itself confronting a problem it wasn't prepared for: diminishing control without open confrontation. The Treasury can still target institutions, the Federal Reserve can still adjust rates, but what happens when nations no longer depend on dollar liquidity or U.S.-backed clearinghouses? According to former Treasury official Mark Soyle, the U.S. is facing a new reality, one where its economic tools are calibrated for a world that's already moved on. Even allies are hedging. Japan has initiated limited ECNY testing for regional supply chain settlements. The EU is expanding its own digital euro pilots, while ASEAN members deepen financial ties with China. These moves aren't overt acts of defiance, they're insurance policies. The U.S. can't sanction what it doesn't touch, and it can't influence trade routes that don't run through its banks. Trump's aggressive economic stance may have triggered this cascade, but it's a system-wide response now. And in this new networked reality, America's greatest weapon, its currency, is slowly losing the battle. Not through conflict, but through quiet abandonment. This is no longer about tariffs or trade deficits, it's about architecture, the hidden pipelines of global power. For decades, the dollar wasn't just a currency, it was a gatekeeper. It dictated who could trade, how fast, and on what terms. But now, as China builds its own financial highways, complete with digital currencies, bilateral clearing systems, and programmable trade tools, the rules are being rewritten in real time. Trump's tariffs may have been designed to protect American jobs, but in the long run, they may have done something far more consequential: pushed the world to accelerate its exit from U.S. financial dependence. And the irony? The dollar isn't collapsing from foreign assault, but from global adaptation. So here's the question that looms over Washington, Wall Street, and every boardroom on the planet. What happens when the next global crisis hits, and the liquidity lifeline doesn't come from the Federal Reserve, but from Beijing? When countries don't look to New York for bailout dollars, but to Shanghai for programmable rescue packages? Because in this new age of trade wars and financial realignment, the winner may not be the loudest nation, but the one quietly laying the rails the world now runs on.